Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Barnes Creative Studios. Check them out if you need some property videos or you need anything related to video and commercial real estate. Do check them out. Their website is barnescreativestudios.com. Well, one of the largest organizations or associations, if you will, in the world is NAR, the National Association of Realtors. And they do a really good job of economic outlook and looking at the market. And while a lot of folks think of the National Association of Realtors as a residential based association, they're very much in commercial. And they do a great job also of watching and checking the commercial real estate world and their economic outlook and their outlook of the different property sectors. So you're in for a treat. Please welcome my guest. It's Cororotan. She is a senior economist with NAR, the National Association of Realtors. Gay, thank you for being with us.
Thank you, Michael, for having me.
Well, great. Well, the first question, Gay, as an economist, I have to ask you is just, hey, where are we here at the beginning of the second quarter? Seems like commercial real estate's going okay. Housing's doing fantastic, but we have a lot of things going on in the world, right? We have gas prices going up. We have inflation. We have a war going on. We have interest rates rising. So when you just look at the economic outlook for 2022, what do you see right now?
Well, right now, the economy is still doing pretty well. The Russia-Ukraine war just began, and we're still seeing the impact of that on higher oil prices. Interest rates were expected to increase. The Federal Reserve Board had already telegraphed that last year. So, we're still kind of assessing what the impact is. But essentially, right now, even the IMF is saying that the impact is not expected to be that significant in terms of an economic reduction in growth. First of all, the U.S. Trade with Russia is very small. So Russia is not like China, where you had that impact on the economy when we had that U.S. Trade war. Still very small, but right now the impact of rising rates are starting to feed through the housing market. We're not seeing that yet on the commercial real estate, and as we can discuss this later. But with rising mortgage rates, as you know, there's an incentive for people to stay in their homes, stay as renters rather than move into home ownership, and so that's actually a good thing, at least for the multifamily market. Certainly, inflation is taking a hit on consumers' pockets. 8.5% inflation was the recent reading for March. Never seen this inflation rate in the last 40 years. That's about $500 that consumers have to spend. And, for the housing market, that means $500 less, right, on the amount that you can pay for a mortgage. And, inflation of 8.5 is outpacing your wage growth of about 5%. So purchasing power is being cut. So consumers are trying to stretch that budget. But right now, of course, a lot of headwinds, more headwinds than we saw at the beginning of the year. But the economy is still at a strong point. Inflation, unemployment is still very low. Job openings are outpacing job growth by 2 to 1. So I think the Fed is saying that the economy can take a little bit of that higher interest rate, slower growth, so that you don't see inflation continuing to ramp up, because inflation cannot become a runaway kind of inflation. It will affect your interest rates. It will affect purchasing power. So the Fed is trying to control that right now. But again, back to your question, where are we right now? Headwinds certainly for economic growth, but the economy is still in a strong footing right now to withstand those high interest rates that the Fed is planning.
Okay. And with inflation coming in at a staggering 8.5%, should that indicate to us to expect maybe higher rate increases from the Fed to counteract that?
Yes. Well, so the Fed is already planning, and they have announced actually in their last meeting that the federal funds rate is likely to hit about 1.9% by the end of the year. So it's now at 0.5%. So that's about 0.25 basis points, every time they meet for the next 6 meetings that they're going to have. And then for next year, 2023, the Fed funds rate is going to go up, at least based on the votes right now of your 16 members of the Fed. The median is 2.9%. So another percentage point next year. So that's why here's the thing, right? We know that mortgage rates are going to rise about 5.5 to 6% by the end of this year, but they're going to rise further next year because by next year inflation will still not have been controlled to about 2%, which is the target of the Fed. So at the rate inflation is going right now, 8.5, I expect the inflation rate to hit about 5.5 next year, and then 2024 by about 3.5. So still a long way. So the Fed will continue to keep putting that brake on monetary policy up until 2024. So yes, certainly expect higher rates this year. In terms of the mortgage rate, that's about 5.5 to 6%. Or in terms of your 10-year Treasury, expect another about 1.5% more this year, and then another percentage point next year,
Yeah.
because inflation is so high, and the Fed wants to control that inflation. And the economy is at a point right now where the economy can take that monetary tightening. As I said, job openings are outpacing job job seekers by two
Right.
to one.
Right. And one thing that help us, Gay, to put this in perspective when it comes to interest rates is, shouldn't we need to look at interest rates kind of historically? And I put this in perspective. We see these relatively large increases. I know I've got a couple, some of my young brokers like, oh, these interest rates are terrible, terrible. And I'm like, no, when you think historically, they're still really low, right?
That's right. That's right. Before the pandemic hit 2019, your 30-year rate for mortgage rates was about running at about 5%. So yeah, still historically low, and we are not at the point where we were in 1982. So in 1982, even if the inflation was hovering at about 10%, 15% even, uh, recall that the chairman of the Fed then, Paul Volcker, said, "Well, the only way we can control inflation is if interest rates, shoot up." And interest rates went up to about 15%. Right now, even if inflation is at a high 8.5, your rates are still low. So, in fact, we have negative real rates right now. So, if you're a borrower, right, good to borrow. Good to borrow money still. Uh, which is why with those negative real rates, and if inflation doesn't come down, I think rates will go even higher because you can't have negative rates also, right? If you're a lender,
Yeah. Yeah. And there's certainly,
make money with negative interest rates.
and as you mentioned, kind of the outlook for commercial real estate seems to be still really positive, and a lot of people would say that inflation, commercial real estate investing or real estate investing in general, is a hedge against inflation. When it comes to foreign investors buying commercial properties and multifamily properties in the U.S., what are the trends there? With COVID having gone on, and now the Ukraine terror going on there. What are you seeing for trends for foreign investors into U.S. commercial properties?
I see a positive trend. First of all, if you look at the world, right, where is a country that is more stable than the U.S.? Where is a country in the world that is more stable than the U.S.?
Mhm.
No other country, I would think, right? Europe, because of the Russia-Ukraine tension, those geopolitical tensions, just by proximity,
Yeah.
could spread. Of course, right now we know that Russia has already withdrawn from Ukraine, but just because of that proximity, that there's more geopolitical risk in Europe than in the United States. Uh, China, because of its alignment with Russia, and because it's again seeing rising cases of the virus, um, they're also kind of in a difficult spot. But the U.S. economy, as I said, are growing pretty strong. Your REITs, if you look at the data on REIT funds, high returns, and just because of this inflation hedge, right now we're seeing rental rates, asking rents going up by about 10 to 15%. So certainly, the multifamily market in the United States is a pretty strong investment area. And right now, we're not just seeing investments in multifamily. We're seeing lots of investments in single family rentals. And that's because prices are rising. And so investors are saying, well, homeowners might not be able to afford that mortgage. And because of the coming of coming in coming out of home, coming out of their households, breaking out of their households for the millennials, right? They're starting to form households. Investors are saying we need to provide single family rentals from them. And of course, there was the pandemic where people didn't want to stay in multifamily homes; they wanted to stay in single family homes. So the single family market right now is what they're calling to be already a different property class.
Yeah.
So those two areas alone, multifamily, single family, will be good investments in the United States. Certainly, the industrial property market will continue to boom. Um, we didn't see a pullback in e-commerce sales, even if the economy opened, not a pullback at all. Of course, the retail trade is also trying to adapt itself to e-commerce. We know cases of Target and Walmart. They're also trying to break into this e-commerce, but e-commerce is going to continue to be strong, and there's going to be a shift now from what you call your just-in-time inventory management to your just-in-case inventory management, right? Because of the supply chain issues. Whereas before you could easily order, the shipment is going to come.
Hmm.
You know that hasn't been the case now for the past 2 years, and so there's going to be a demand for warehouses and data centers. Data
Yeah.
centers is one other property market that has been very strong, at least when it comes to REITs investments. People are working from home. There's a lot more online shopping. You know, the, the world is just shifting towards more data driven AI, smart growth technology. So, you
Yeah.
need these data centers.
Yeah.
You need this infrastructure. And so
Yeah.
data centers is a really a positive area for investment right now.
Yeah, and you mentioned infrastructure. Let's talk about that too, because we have kind of a $5 billion investment there. Tell us about that and the impact.
Yeah, correct. So, well, it's overall, it's really $1 trillion in infrastructure spending, and that was really the purpose of the Biden administration to make sure that this federal spending continued to prop up economic growth. But it was just a basic common sense, right? We had aging roads, dilapidated bridges, unsafe bridges, and so you were kind of hitting two birds with one stone. And you also wanted the Biden administration also wants a cleaner environment. So I'd say three stones. You kill three birds with one stone, right? You're improving environmental sustainability. You're propping up the economy. You're improving infrastructure. Now, specifically for the real estate market, I think one thing that will be positive is the 5 billion allocation for these electric charging stations. And we know gas prices are rising right now. They'll probably remain at this level about $100. And even if they don't, during the 70s, we saw this transition of the U.S. economy from an energy dependent economy into an economy where it is now a net exporter. So I think this high gas prices now, and all this tension is going to uh, shift the demand for vehicles towards electric vehicles. That's already about a million vehicles out there right now. So yeah, states like California, Texas, Arizona, even the Washington D.C. area, the New York area, lots of demand there for electric charging stations, and those electric charging stations have a synergy effect with your retail trade. Everyone knows that when they come to charge at Target and Whole Foods, you make a quick dash, buy coffee, get some salad, get some food, um, and if you're doing level two charging, say you go to Target, well, those 2 hours are going to give you some time to go shopping. So I personally believe that this synergy between electric vehicle charging stations and retail trade is something that will be good for the commercial market. So right now you have about 100,000 electric chargers. The administration wants to beef that up to about 500,000 chargers in what it calls the electric vehicle alternative fuel corridors. And you can only be a fuel corridor if there's an electric charging station every 50 miles, right? Because that's the fear that you're driving and you run out of battery. So every 50 miles, there's going to be a charging station. So think of the implication of that for retail trade, right? And for the demand for land. If every 50 miles you need to have that charging station put up. So I think it's great for the land market and then great for your retail trade market.
Yeah, good point. Because if you stopped every 50 miles and you get a charge, you might want to go in and do some shopping, right? Or
Yes. Yeah.
done.
Well, they want these quick chargers, right? 20 minutes, 15 to 20 minutes. Yeah, but in those 15 to 20 minutes, hey, you can get coffee, you can get your salad,
Yeah.
you can get whatever. Make sure you have that list, though, right? You don't want to spend time looking around the shop and get that penalty because you overstayed at a charging station.
Yeah, that's right. But you can spend a lot in 20 minutes, especially online, but I guess in person as well. Well, Gay, what would you leave our audience with to think about for commercial real estate moving forward for the rest of this year and into next?
I think commercial real estate will continue to do well, particularly for the multifamily sector and the industrial market. Now, even for retail, uh, this 8.5 inflation is taking a hit on consumers' pockets. People are spending like $500 more every month, right? And where are they going to be spending that? Basic commodities, for food, essentials. And so your neighborhood centers, your strip centers done by your neighborhood, those are continue to do well. Now malls, probably still will continue to face that headwind and that challenge. Right now, vacancy rates for malls is at 8%. So still a difficult time for malls, but for neighborhood centers, strip centers, I think the retail trade will do well in those markets. Office sector, we've seen a return to working from home. About just 20% of your workforce is working from home now, compared to about 50 to 65% prior to the pandemic. We are seeing though some decline in density, but I think the ball is still up in the air, because even if people work from home 2 days, 3 days a week, right? Then they come to the office. Well, once they have those meetings, the big meetings, which is the purpose of the office, right? The purpose of the office now is now to be that place where people can collaborate, can meet, can discuss as one group. And if you bring them, all of your employees, I don't know, once every 2 weeks, where are you going to put them? And so I'm not really sure that even if people are working from home, that office space will be reduced. Now, if it does, on the aggregate, there might still be a demand for this hot desking, which your WeWork type of offices cater to. It's still up in the air what the impact of the office is, but certainly we're seeing that in markets like New York, San Francisco, DC. the major areas, still a lot of lost office space that needs to be recovered. All in all, about 115 million square feet. Vacancy rate overall is about 12%, but we're not going to see vacancy rates going down to below 10%, I would say, over the next 3 years. So that would mean office rents will remain soft, probably rising just about 1%. Now, having said that, in the office market, it's a bifurcated recovery. New York, San Francisco, DC, Chicago, recovering but not doing as well, but areas like Austin, Dallas, Phoenix, Tampa, Raleigh, the secondary markets where there's a lot of migration. Office markets there uh, are doing well. Rent growth is up 5% year over year in those markets. So if you were an investor, you know, um, again, this what you call the secondary, tertiary markets is where the action is going to be if you're in the office sector.
Yeah. Yeah, I agree. I think the downfall of the office is over exaggerated. I think because of recruiting and onboarding and training and culture and cybersecurity and trade secrets, collaboration, profits, growth, and for careers. I think the office market will come back stronger than people are thinking right now, since we just went through this,
Yeah,
oh,
yeah.
we don't want to be around people kind of stuff.
Oh, yeah, correct. And I think, yeah, even Google, right? The tech companies, they've always planned on their workforce returning to the office.
Hmm.
It's just that, the pandemic, kept holding that back. But really, the intent is for the office workers to come back. Now, it won't be 5 days a week, but certainly, 2 to 3 days a week. But that still means that there's a demand for office space. And as I said, if you want places to collaborate, where are you going to put all these workers when they come to the office?
That's right.
If that's the only purpose now for the existence of the office, right?
Yeah, perfect. Well, Gay, thank you for being on the show. Great information. Thanks for joining us.
Okay. Thank you for having me, Michael.
All
Thanks.
right. Thank you. And thank you for joining us around the country. Please let us know what you think. Hey, we do love hearing from you. So reach out to us through your favorite social media, or you can always reach out to me directly. My email is michael@bullrealty.com. Well, until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1 up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.